We'll give it another minute and then we'll get underway. See if any of the stragglers come in. Must be getting close. Hope everyone's had a good day. It's Thursday, one day to go before the end of the week. All right, I think we'll kick off and get underway. All right, so welcome everyone. Thanks for coming along and sharing your Thursday night with me. My name's Glenn Newbery, and tonight we're going to be talking about using property investing to buy your first home in Sydney. So as we know, that's a bit of a struggle for a lot of people. So what we're going to do is we're going to be covering a few topics, understanding the Sydney market, challenges for first home buyers, the government assistance that's out there for first home buyers as well. We're going to be talking about rent vesting, investing in other markets, mitigating risk, and financial considerations. So for those of you that don't know me, or this is your first time you've seen me, so my name's Glenn Newbery. I am a property investment advisor and a buyer's agent and have been for 10 years. I've assisted hundreds of people to invest in property, either starting their journey or continuing their journey. And I've been a property investor myself for 26 years now, and bought and sold over 30 properties for myself, both in Australia and New Zealand. I've used lots of different strategies over that time. I currently hold 20 investment properties, which generate an income of about $8,750 a week in rental income. I'm always continually educating myself. Just last weekend gone, I spent 3 days at a property development seminar. You can never know everything there is to know about property investing. And I love just to continue educating myself with regards to everything property investing. And I'm also a member of several property networking groups. And I love keeping in that space and sharing knowledge, but also, networking with other property investors as well. So before we get underway, unfortunately, with the society that we live in today, with the litigation, I'm not a solicitor, I'm not an accountant, I'm not a financial advisor. So all of the information that I share in here is of general nature, and it's not meant to constitute specific advice. I'm just talking about my experiences and those of some of my clients. Everybody's circumstance is different. Their financial positions are different. Their goals are different. So you really need to seek that professional advice that is right for you. So make sure you do that. Speak to the appropriate professionals to help you on your journey. Righty. So I wanted to start off tonight about talking about the Sydney property market and where it's going, where it's been. So if we look way back, so this is a graph that I got from CoreLogic. And for those of you who don't know, CoreLogic is a data center. They record every single property sale in Australia, and then they use that data to show what's going on in the different markets. And data always tells a story. And exactly what we're seeing here is telling a story about the Sydney market. So if we look back in October 2023, you'll see that the Sydney market, so CoreLogic use an indices number, and what that allows them to do is really rank the capital cities against each other. So what you see here is the CoreLogic indice for Sydney back in October 2023 was 228. And if we look at where it is today in October 2024, it's 236, which is an increase of 8.6 points, right, over that 12-month period. But what's really interesting about this graph is when you look at when the growth really kind of started to kick off was around about December in 2023. And that was because we had our last interest rate rise in November 2023, and it was broadly spoken that was probably going to be the last interest rate rise we saw. So that gave people confidence. And you can see as we went into January and February, that really picked up because that confidence grew that we weren't going to see any more interest rate rises, especially in the short term. And then what you can see here around June this year is you definitely see a shift in the trajectory of that line. So if we look at where it was and the rate where it was going from December to January, you can see that trajectory is, probably at a 45-degree angle. And then when you look from June this year onwards, you can see it's much, much flatter. So what that tells is that the Sydney market is slowing down and starting to flatten out. So that's good news for people, I guess. There is a slight incline there, but it is good news to say that, we're not seeing those really big price rises now in the Sydney market. So again, looking at some more CoreLogic data here, Sydney property dwellings are at an all-time high from a price perspective. So over the last 12 months, it's grown about 4.5%. And just in the month of September, it grew by about 0.2, and over the last quarter, it's 0.5. And if we look at what CoreLogic suggests the median house price in Sydney is right now, it's about $1.18 million, or closing up to 1.19. So obviously at that sort of price point, it's quite challenging for a lot of people, and especially first home buyers. So I wanted to talk about the challenges that first home buyers are seeing in the market, and what we're, certainly what I'm hearing in the market as well, is that let's, as we say, assume that the house price in Sydney is about $1 million, right? And if you're a first home buyer and you're trying to get into that market, really difficult to save a deposit. But let's say you've got a 10% deposit saved, which is $100,000, right? So that gives you your 10%, but then you need to borrow 90%. But the issue that we're seeing is a lot of people's borrowing capacity is tapped out at around about $600,000. And of course, what that means is there's a shortfall of $300,000 between, what they can get from a borrowing capacity and what they need to actually get into that first home and be able to buy. So, and obviously, saving is an issue in today's environment with the cost of living where it is. So I wanted to just do a quick poll here and see how much, for those of you out here that are looking to purchase your home, I just wanted to try and get a gauge of how much you think that you can save per week to put towards a deposit on your first home. So I'm just going to put a poll up here and see if we can get some results in there, because obviously if you can save up to $200 a week, sorry, it'd be great to save $200,000 a week, wouldn't it? If you can save $200 a week, then that's probably about $10,000 a year, right? Obviously, $300 a week is about $15,000 a year, and $400 a week is obviously about $20,000 a year. And if you can do even $500, it's about $25,000 per year that you can save towards that deposit. So I'm just going to end the poll now. And it seems that, most people can save around about that $300 to $400 a week towards their deposit, which means, probably around about a maximum of $20,000 a year, right? So if your shortfall is $300,000, it's going to take you a really long time to be able to get that additional capital or deposit to be able to purchase that $1 million home. Now, there are some grants that you can get from the government. So if you're buying up to $1 million, you can get a $30,000 stamp duty exemption, up to $30,000. And there are conditions attached to that. And that's through the New South Wales First Home Buyers Assistance Scheme. But that's on the stamp duty. That doesn't help you with a deposit, right? But yes, it's $30,000 you potentially don't have to spend when you're buying that home. And also you can get up to $10,000 for a newly built or substantially renovated home, but only up to the value of $600,000. So if you're trying to buy $1 million property, you're not going to qualify for that $10,000. It has to be $600,000 or under to qualify for that $10,000 first homeowner grant. And again, there are conditions and rules that apply to that. So what I wanted to talk about was rent vesting. Now, what is rent vesting? Some of you may not know what that is. So rent vesting is a home owning strategy where you rent a property to live in that's right for your lifestyle. And while you're renting, you then own an investment property that's right for your budget, right? And as home prices in the inner city areas have gone up, this strategy has become increasingly popular, especially amongst the younger buyers. And the strategy would be to buy that investment property and get some really good growth out of it. So make sure you're buying in the right location, get some really good growth out of it, over a 3 to say 5 year time frame, and then sell that investment property down and use the profit as a larger deposit. So I just wanted to give you a bit of an example about rent vesting and what that's going to mean from a cash flow and what that's going to really look like, from that sort of cash flow perspective. So what I did, again, I downloaded some data from CoreLogic. And in this scenario, I wanted to find something that was around about that $1 million price point. So Cronulla, great lifestyle location here in Sydney. And a lot of people, like to live in Cronulla. And so the median unit value in Cronulla is $1.12 million as at September 2024. So it's around about that $1 million mark. So for the example here, I'm going to use $1 million, right? And the average rent, the median rent for a unit in Cronulla is $650 a week. So let's use some of those numbers and do a bit of an example here. So if you wanted to rent that $1 million unit in Cronulla, that'd cost you around $650 a week. Now, if it was a 2-bedroom unit and you were open to having a flatmate, then that would potentially bring that cost down to $325 a week. So, reasonably cheap to live in a great lifestyle location. Now, if you wanted to buy or own that $1 million unit in Cronulla, assuming you have principal and interest loan. Now, what I did with the interest rates, that interest rate there, 6.79% per annum, is a standard variable rate home loan. I got that straight off the CBA website for an owner-occupied home and borrowing more than 80% but under 90%. So in the example, we were talking about if you have a $100,000 deposit and you're buying $1 million property, you're going to need to borrow $900,000, which is 90% of the value of the property. So that would fit in with this particular loan. So principal and interest loan at a 6.79% interest rate with a 90% loan would cost around about $1,352 per week just to cover the mortgage. And then as a homeowner, you'd also have the privilege of expecting some significant additional expenses for council rates, insurance, body corporate fees, because we're potentially purchasing a unit, and ongoing maintenance, which would add another, let's call it $150 per week in costs on top of the mortgage repayment. So we're now looking at about $1,502 per week. That's just to own the property. And then you've got all of your other living expenses, your car, your transport, your food, mobile phones, and all the other bits and pieces, gym membership, all on top of that. So you're going to need, at least $1,500 a week plus all of those expenses on top of that. Now, in this example, renting a unit with a flatmate would, if you did that, it would save you about $1,177 a week over purchasing that property, right? Because you'd only be paying $325. If you take that off the $1,502, it leaves you with $1,177. If you rent, which is about $61,000 per year, you're better off from a cash flow perspective, right? If you rented the unit alone, the savings would still be about $852 a week or $44,000 per year, living potentially in that same unit, renting it as opposed to buying it. Now, if we take this one step further and say, okay, if we were renting this property and then we looked at purchasing an investment property where our budget allowed us to, so again, assuming that we can borrow $600,000 and we have that $100,000 deposit, then let's look at potentially buying, let's say, a property in Western Australia. And down the bottom here, again, I just picked a suburb in Western Australia, Kelmscott, where the median value as of September 24 was around that $650,000 mark. Now, the median rental price in Kelmscott is about $580 per week. So you can see we're only spending $650,000 here and getting $580 a week, where if you purchased $1 million property, you might only be getting $650 a week. So there's only $70 a week difference, but there's $350,000 difference in the purchase price. So to own a $650,000 investment property, and again, assuming a principal and interest loan at 7.4%. And once again, I went onto the CBA website and I downloaded this interest rate, which is for an investment loan, not an owner-occupied loan. And again, borrowing up to 90%, standard variable rate, 7.04. Now, you can potentially get better interest rates than that, but I just pulled it straight off the CBA website for the example tonight. So that would cost you around $902 per week. And again, for the privilege of being a property owner and a property investor, you would also expect significant additional expenses, again, council rates and interest, but this time you've also got property management costs and ongoing maintenance costs. Let's say that's going to cost about $200 per week. So now we're up for about $1,102 per week. However, we're getting $580 a week in rent to help us cover that $1,102. So in this example, to purchase an investment property would cost around about $522 per week out of your pocket, which is about $27,000 per year after that rental income has been taken out of what the expenses are. So if we now looked at that from a cash flow perspective, you'd be about $330 per week or $17,000 per year better off by renting the property and owning an investment property in a different location where you can afford. And that's all before tax benefits. So obviously, as a property investor and a property owner, there are some tax benefits, namely depreciation and negative gearing. And let's estimate that at another $6,000 per year for someone earning around about $100,000 a year. So you're actually going to be around about $23,000 per year better off by renting that property, the $1 million unit in Cronulla, and owning an investment property, say, in Western Australia. Now, one thing to note here is that I did use principal and interest amounts for the investment property. Now, in investing world, typically you would use interest-only loans as opposed to principal and interest. But I wanted to give you a worst-case scenario. If you did purchase the investment property with an interest-only loan, that figure would be much higher because your repayments would be lower. And yes, you might pay a little bit more of an higher interest rate because you're going interest only as opposed to principal and interest. But again, you're still going to be much, much better off from a cash flow perspective. And as well, the second thing to note is that if you're only buying a $650,000 property and you're borrowing 90%, you would only need borrowing capacity of $585,000. So earlier on, we were talking about having a borrowing capacity of $600,000. So this would fit in perfectly with that for the person that could only borrow about $600,000. Whereas if you wanted to buy that $1 million investment, that $1 million unit in Cronulla to live in, you're going to need to borrow $900,000, and you're going to need a pretty good income to be able to borrow that much money. So there's some options with rent vesting, and why, sometimes it really does make sense to rent vest rather than own the property you want to live in. And I'm not saying don't ever buy a property to live in, but use rent vesting to help you. And I'm going to talk a bit more about that down the track. So let's look at investing in other markets and let's see where they are and what where the opportunities lie. So if we look at Melbourne, so Melbourne is a little in the doldrums a little bit at the moment. The market peak in Melbourne was back in March 2022, and since then the market's dropped by about 5%, and you can see there the figure minus 1.4%. That's over the last 12 months. Over the last quarter alone, it was 1.1%, and some of that would have been on the back of the Victorian government reducing the land tax threshold in Victoria to $50,000. So pretty much anyone that owns an investment property in Victoria now will be paying land tax. Unfortunately, that means that a lot of investors are actually getting out of the Melbourne market. So I do see that there will be opportunities in the Melbourne market down the track, but not yet. It's a bit too early. As you can see, the numbers are still going the wrong way. So the trend is all downwards at the moment. So a bit too early to be jumping into that market, but I do see opportunities in there down the track. Now, the median price in Melbourne, $776,000. It's now number 6 across the capital states in Australia. It used to be number 2 behind Sydney. It is now ranked number 6 from a median price point perspective. Let's move on to Hobart. Hobart also reached its peak way back in March 2022. It similarly is down over 12% since then. Over the last 12 months, 1.1% down, and all of those values are decreasing. So again, the trend is going in the wrong direction for investing. Median price point there, $655,000, ranked number 7, right behind Melbourne as far as the median price in capital cities go. Canberra market. So Canberra also reached its peak back in 2022 in May. It's, a little bit of growth there, but it's kind of flatlining, going up and down a little bit, as you can see there. Some's up, some's down. So again, it's a bit of a flat market at the moment. Median price there, $845,000, ranked number 3 of the capital cities across Australia. Darwin, its peak was way back in May 2014, and it is still substantially below that price point now. And again, you can see some of the values are up, some are down, so it's kind of flatlining a little bit at the moment. And again, not a market that we'd recommend investing in at this point. Median price point, $504,000. It runs last out of all of the capital cities, ranked at number 8 from a median price point perspective. Then we move on to Brisbane. So Brisbane, a bit more sunshine there as far as the price point goes. And it's currently at record highs, the price points there. 14.5% over the last 12 months. You can see over the last quarter, 2.7%, and just over September alone, 0.9%. The issue that I see with Brisbane is the price point to get in. At $875,000, it is now ranked second behind Sydney from a median price point perspective. So the issue there is you're going to need to be able to borrow substantially more money. If you can only borrow $600,000 and got $100,000 deposit, there's a bit of a shortfall there. So that's going to be an issue. Adelaide market also at record highs at this point in time, 14.8% growth over the last 12 months and 4% just over the last quarter and 1.3% just in September alone. But if I wind the clock back probably 18 months ago, Adelaide, that 12-month growth would have been in excess of 20%. So what I'm seeing in the Adelaide market now is it's starting to come off a little bit. It's still in positive growth territory, but I'm starting to see that growth rate decline slowly, right? So it's heading back down. It's still growing, but the growth rate is slowing down. So it's getting to the point where it's going to start leveling out in the not too distant future. Median price point there, $790,000. It is number 4 behind Canberra. And that, of course, leaves Perth. So Perth market, you can see that growth rate there. It is also currently at record high levels for price, 24% over the last 12 months growth. Last quarter, 4.7%, and just in September alone, 4.6%. 1.6% growth just in September. Its median price point, $785, just a touch behind the Adelaide market and comes in at number 5. So I thought we'd take a deeper look into the Perth market. So here's the graph. This is exactly the same graph that I showed for Sydney market, but this is showing the Perth market. And again, it has the indices there. So if I look at where the CoreLogic index was back in October 23, it was at 139 points, and roll that 12 months forward to today, it is now 171. So it's grown by 32 points over the last 12 months in comparison to Sydney's 8 points over the last 12 months. So you can see it's had 4 times the growth that the Sydney market has in the last 12 months. So performing really, really strongly. And when you look at the trajectory, it's a straight line up, right? But the key thing is, at the end of that arrow, we don't see any tapering off at this point. So the trajectory is still going in that linear straight line. So I don't think it's going to change anytime soon from a growth perspective. Sure, the growth rate might come down a little bit. But what I thought I'd do is I'd show you, so at Suburbanite, what we do is every month we create this market health check. And in January 24 this year, the growth rate in Perth was 15.2%. And if I roll that forward to today, October, currently 29.8% growth rate. So you can see how much that growth rate has changed just in the 9 months since January. So let's have a look at the Perth price points. Now, minimum price point, that is not the cheapest property you can buy in Perth. At Suburbanite, we wouldn't like to buy the cheapest property you can buy in Perth. We look at certain things where we want to make sure that, we're getting a good property in a good location and we're going to have a good tenant profile. We know we can achieve that at around about that $570,000 mark. But really the ideal price point, in my opinion, in the Perth market is somewhere between that $630,000 and $680,000. And as we spoke about before, if we targeted that $650,000 property, it is right in the middle of that $630,000 to $680,000 price point. So so if that was a scenario where you could borrow $600,000 and you had that $100,000 saved, it would be a great location to get into. So I thought I'd share some case studies just to some properties that we've purchased for our clients in recent times, and just show you what that looks like a little bit down the track. So this particular property here, we purchased for a client just back in November last year. So you can see down the bottom there, November 23, for a price of $500,000. Now, I generated this report, which is an automated valuation through CoreLogic. So not always 100% accurate, but you can see there, estimated value of confidence is quite high. And I prepared this report earlier this month on the 6th of October this year. The current estimated value of this property is $625,000. So this client has enjoyed 25% growth in the last 11 months, which is like $125,000. Now, going back to how much people could save per week, if that was $500 per week over a year, that's $25,000. This property has been able to grow by 5 times what someone that could save $500 a week would be able to save in that 12-month time frame. So really moves you towards filling that $300,000 gap that there was in the shortfall for that $1 million property purchase. And I wanted to also share this one as well, which was it going to talk to me? Yeah, there we go. This is an older property or property that we purchased a little bit earlier, about 12 months before that one, which was back in December 2022. And this property we purchased for the client at $515,000. And again, you can see I ran this report back on the 6th of October 2024. So from $515,000 purchase price, the estimated value on this property now is $745,000. So this client has enjoyed 44% growth in just 22 months, which equates to about $230,000 in equity. So you can see again, if we've got that $300,000 shortfall, we're moving very close to that amount. So this is why I see Rentvesting as a really good opportunity to enable you to get into your first home in Sydney by doing that. Now, you might be asking, well, these properties have grown a lot. Is it too late to get into the Perth market? So let's have a look at that. So we talk about property cycles, and you may well have heard that property doubles in value every 7 to 10 years. Now, that is not true. It certainly can be in some instances, but is not a general rule at all. But when we look at how a property cycle runs, so from the peak of the market to the next peak of the market is typically around about that 10-year time frame, from when it hits the top and then goes flat and then it starts growing and hits the top again. It's around about that 10-year time frame. But out of that 10 years, the growth phase is really only about 3 years, from when it starts to grow to when it kind of hits that peak. And so when we're looking to buy an investment property, what we really want to do is get in somewhere from that red dot and onwards into that growth phase, because we want to make sure that we're getting growth pretty much from day one to start building in that equity as quickly as possible. Now, when that grows, what typically happens is it hits the peak, which is the peak growth rate. It doesn't mean it's the peak price point. And then that growth rate will slow down and get back down to zero. So that's where you can see where it crosses over the white line just here. You can see where it crosses over there. That's zero. And then it goes into negative growth. And that's where you'll see prices starting to fall, right? But they don't fall too much. It's just a slight correction. And then it comes back into the green again. And then it'll go up and down for a period and then stabilize before it cycles back around and comes back into that growth phase again. So we really want to be getting into that market when it's in that growth phase or just about to come into that growth phase. And, there's obviously a lot of data that we can look at that kind of indicates that. There's no guarantees, but of course, when you look at certain indicators, it will tell you that the market is likely to be going into growth. So let's talk about some risk factors and mitigation strategies. So look, whenever you're investing, there is always risk. There is no such thing as a risk-free investment. So you need to understand what those risks are and how to minimize them. So one of those things is, as I've just mentioned, is purchase in a rising market. And the reason that we want to do that is because we want to build in that equity as quickly as possible. Because if something happens, something unexpected happens, and we need to sell that property much earlier than we intended to, then we need to have had growth in that property to try and minimize any potential risk of losing money. Because if we buy a property that's in a stagnant market and it's flat, and then we need to sell it unexpectedly, earlier than what we wanted to, and even if you sell it at the same price you bought it for, you're going to lose money because you paid for stamp duty and legals and everything on the way in, and then you paid for selling costs and legals on the way out, as well as the holding costs over the time frame that you've held it. So you're actually going to lose money. That's why you want to be building in that equity as quickly as possible to minimize that risk of loss in the event that you need to sell unexpectedly. Also, having a great team behind you is crucial to your success. Having a really good accountant, hi Jerry, I saw you on there today. Having a really great accountant who can really give you strategies, tax-effective strategies. It's not about tax avoidance, that is illegal, but there are strategies that you can use to help minimize tax, and a great accountant can help you with that. Having a great mortgage broker, and again, I know there's a couple of mortgage brokers online here. Having a great mortgage broker who can make sure they're getting you the right loan for your scenario, getting a really good rate, much better than the 7.04 that I showed before, it is really good. And make sure they're reviewing that rate, over the period that you own the property to make sure you're always getting the best deal. Having a great financial advisor, and yes, I know there's Heath on here as well, because once you buy an investment or any property for that matter, you're taking on a loan and taking on risk. So you need to make sure that you're looking at all of your insurances, having those reviewed by a financial advisor, and also Max, sorry, I forgot Max is on here as well. Having a great advisor who can review your insurances and make sure that you're adequately protected in the event that something goes wrong, right? But also the other thing is, property is one type of investment asset. There are plenty of other types of investment assets, and you should consider investing in other asset types to diversify your investment portfolio, and that also helps to minimize risk. Property managers. So property managers are worth their weight in gold. They are really important to holding an investment property, making sure that you get the right tenant. Now, having a great property manager isn't a guarantee you're not going to get a bad tenant, but having a bad property manager, you're almost certainly going to get a bad tenant, and it's going to be a bit of an issue, right? So typically in property management, you get what you pay for, and make sure you get a good property manager who is going to do all the right things to make sure you get the right tenant in there and minimize that risk of tenant risk. And also an insurance broker. Insuring the property is also crucial. Make sure that you're covered for all of the things that you need to be covered for. I'm not an insurance advisor. I'm not giving insurance advice, but make sure that you get coverage for loss of rent and also malicious damage, because those are things that can come up. Now, insurance policies aren't all created equal, and some of those will cover you for that or a little bit. Some will cover you for more. Not giving insurance advice. Speak to an insurance broker to help you with that, and make sure that you get the right advice around the insurance on the property. And last, and probably most importantly for me anyway, and it's a strategy that I've always used with my investing, purchase properties that are affordable to the mass market. Because when you're buying properties that are affordable to the mass market, that means that you have a larger pool of people that can potentially buy that property from you. The more people that can afford to buy it, the more demand there will be for that product. The more demand there is, the faster that property will grow in value, and the easier it is for you to offload it if you need to unexpectedly again. But not only that, if the property is affordable to buy, then it's also likely to be affordable to rent. And if it's affordable to rent, again, you have a larger pool of potential tenants that you can rent that property to. And the more tenants you can rent it to, the more demand there is in that market. The more demand there is, then the lower the vacancy, right? So if the property does go vacant, then you'll be able to rent it out faster because that property appeals to a larger number of potential tenants, but also the higher the rental return will be, which means less out of your pocket to hold on to that property. So always look for something that is affordable. They are less volatile. Quite often the higher value properties are a lot more volatile when the market shifts up and down, whereas the affordable properties are not as volatile. They don't drop as much. They might not grow as much either, but the risk of losing money is far less, in my opinion. Also, there are some financial considerations. Understand your cash flow. This is probably the biggest issue that I see with most investors is they don't look at cash flow. They're too focused on the capital growth of the property, but they don't understand what the cash flow is going to look like. What do I mean by cash flow? Income minus expenses, right? Property investing is a business like any other business. It has income and it has expenses. And you need to understand what that's going to look like from a cash flow, right? What's the income you're getting in? What are your expenses going out? And what's left over, or how much negative is it? And you need to understand that, because it doesn't matter how much that property grows in value. If you can't sustain negative cash flow, you're not going to be able to benefit from the growth anyway, because you won't be able to hold it, right? And once you hold, if a property has too much negative cash flow, you're not going to be able to hold many properties. So if your goal is to build a portfolio, you need to have good cash flow, because if you don't, you're never going to be able to build a portfolio, because you won't be able to buy more properties. So always understand what your cash flow is going to look like. If you don't know how to work that out, happy to chat to you and show you how you can do that. I have a spreadsheet that I use to work those numbers out on my properties. So I understand what a property is going to look like from a cash flow perspective before I purchase it. And you can stress test it as well. Also, there are some tax benefits. Again, as I said, have a chat to your accountant. There are things like negative gearing and depreciation tax benefits. But also when you sell a property, there's going to be some liability there if the property's grown in value from a capital gains tax perspective. Before you sell a property, make sure you speak to your accountant and get an idea of what that's potentially going to look like from a capital gains tax perspective, so that you know what that's going to be, and you don't just go and spend all the money that you've got and go and buy that property, use that $300,000. You'll have to pay some of that towards capital gains tax. And as I mentioned before, your insurances, so crucial. Make sure you have them in place, because you never know, what can go wrong. So that was pretty much what I wanted to cover from content. Questions, if you've got some questions, just pop them into the chat, because and I'm happy to answer any questions that you might have. So yep, I can see all the comments in there when I thought it had gone. And basically what had happened is another window had popped up on my screen that stopped me from seeing what was going on. I thought it had dropped out, but that's all good. So if you've got any questions, happy to answer any. But if you don't want to ask the questions here, then more than happy to have a 30-minute catch-up. you can scan that QR code that you can see on your screen right now. That will take you to the booking page where you can book in a time. Peter has asked, any suggestions on how to find a good insurance broker? I have a couple that I can introduce you to, so I'm more than happy to do that. Peter, reach out to me and I can introduce you to a good insurance broker. Resource house, apartments, townhouses, houses, what are some things to consider between them as investments? Look, I would always prefer to buy a house, right? House has land component. Houses tend to grow in value much better than units do. And the main reason behind that is because it's much faster to add supply to the unit stock than it is to be able to add houses to the housing stock. So, for example, to build 100 units, they might buy 2 houses next door to each other, knock them over, and build a 10-story high unit block with 10 units on each block. That doesn't take very long to do. They can knock that up, in a pretty short time frame. But if you want to build 100 houses, you need to go and buy acres and acres of land. You've then got to go and put in all the infrastructure, the roads, the water, the power, the sewer, the stormwater. All of that needs to go in. Then they need to subdivide the blocks. Then they need to build 100 houses. It takes a lot longer to add 100 houses to the supply than it does to add 100 units to the supply. Go anywhere, any suburb in Sydney, you'll see high-rise units, right? And we do need that, but to add that supply can be quite quick, and that's why I would always prefer to buy houses because, much less chance of going into oversupply because you only get growth when when demand exceeds supply, not when supply exceeds demand, right? And that's what we see quite often in the unit space where the supply is greater than what the demand is. And that means that property prices will either stay stagnant or they may even drop. So I would always prefer, if you didn't have the budget to actually buy a house, then I would be looking for a townhouse or a villa, because that's the next best thing to a house. And even though you will still have strata or body corporate fees attached to that, potentially, you can get some townhouses and villas that are on Torrens title, which means they're on their own title. But I would shift towards that. Apartments or units would be my last option. So that's what I do. I think that's all. I can't see any other questions there. Like I said, if you'd like to book in a catch up, feel free to scan that QR code. And thanks very much for coming along tonight. Really appreciate your time. I hope you found it beneficial. If you want to add me in as a contact, you can scan the QR code on the left. If you want to follow me on LinkedIn, you can do that by scanning the QR code on the right. And look, if there's anything I can help with, please feel free to reach out. Thanks so much for joining me, and hope to see you again soon.